Hello everyone, I'm Kate Hill and welcome to the Adviseable Advantage Property News Update. Before we get started, please subscribe to our YouTube channel, hit that notification bell so that you don't miss out on further news updates on our suburb analysis reports and our free webinars. This week, I will cover off on Sydney's vacancy rates for investors, the status of national rental stock, the Melbourne property market during COVID-19 lockdown, and I'll give you a finance update. You can then jump to each particular segment that you're interested in if you don't want to watch the whole program. Don't forget that we at Adviseable are out there 24/7 looking at property, analysing property, buying property. We are at the coalface of what is going on out there in real estate world. We are here to help you if you have any questions at all or you need help buying property. Watch our video here, and I've listed it in the description below, to get a national house price update. And let's get started. Research gathered by the Real Estate Institute of New South Wales highlights that parts of Sydney's property market are continuing to show signs of weakness with the fallout from COVID-19, seeing vacancy rates rise. The results have shown that vacancies in Sydney overall increased for the fifth successive month and now sit at 5%, which is up 0.5% from June and up 2% since March. According to the research, the impact of COVID-19 is starting to spread, with the outer Sydney ring experiencing some drops. In a slight turnaround, the exodus from inner city Sydney appears to have eased and now sits at 5.3%, which is down 0.5% from June. Even with the 0.5% drop in July, the vacancy rate for Sydney's inner suburbs is still 2.8% higher than it was back in March. The Real Estate Institute CEO Tim McKibben said that vacancies have been steadily trending downward since March, as inner city tenants relinquished properties with higher weekly rents for more affordable options in the suburbs more distant from the CBD. However, July saw a rise of 1.7% in just 1 month. Sydney's middle ring increased for the fourth successive month and is now at 5.4%, which is up 0.2% from June and 2.2% from March. Further to the figures that I have just talked about, data analysis by CoreLogic has revealed that there has been a significant increase in rental stock around inner city areas around Australia, particularly in Sydney and Melbourne, since the onset of the coronavirus pandemic. This is because the majority of new migrants in Australia initially are renters. The dominance of Sydney and Melbourne with regard to heightened rental supply highlights the much localised nature of the shock to rental demand that has been seen since the onset of the pandemic. These trends have placed downward pressure on rents and upward pressure on vacancy rates. Of the 88 areas that CoreLogic measured across the country, 78 regions declined in the volume of rental listings between these days. Across the 10 regions that have seen a rise in total rental stock, 8 were across Sydney and Melbourne, while rental stock also rose in inner city Brisbane, Adelaide Central and the Adelaide Hills. Some of the largest increases in rental stock is across inner Melbourne and Sydney City and inner South. For example, in Melbourne's South Bank, rental stock has surged from 568 rental listings in the 28 days to the 15th of March to over 1,200 by the 9th of August. We would say that because of the relatively high levels of investors, particularly in inner city apartment markets, the trends in rental supply and demand could indicate added downside risk for values in these areas, certainly until international borders reopen and labour market conditions tighten. However, total rental listings have started to fall across most Melbourne regions as the city faces stage 4 restrictions to curb the second wave of COVID-19 cases. We are currently seeing lower rental yields in Melbourne, but have not yet seen properties fall steeply in value. According to the latest monthly Heron Todd White property report, the stage 4 restrictions in Victoria have not noticeably impacted on house prices. The report has stated that latest statistics show that Melbourne housing values have dropped 1.1% The number of owner-occupiers has increased in demand by 0.5%, and demand from investors has dropped by 0.3%. Melbourne CBD high-rise apartments in the city and fringe areas will suffer the largest price fall as a result of the coronavirus. The past few months have also impacted the rental market, as high rates of unemployment have led to many young people exiting the rental market and moving back in with parents, downsizing or sharing rentals to save money. Closed borders have seen immigration coming to a halt, as well as a sharp decline in international students. This has greatly reduced housing demand, which has caused this spike in vacancy rates, leaving investors a little bit nervous about what's to come. However, areas away from the Melbourne CBD itself appear to have stronger value for investors as Melbourne residents adapt to a new norm of working from home. In finance news, home loans are on the increase as lending restrictions ease. Latest figures from the Australian Bureau of Statistics show that in June, new home loans rose 6.2% compared to May, with the housing finance sector adding $17.4 billion in value. These recent improvements are attributed to COVID-19 restrictions being lifted in most parts of Australia and the announcement of the Home Builder Scheme. The ABS chief economist Bruce Hockman says the rise in housing loan commitments in June reflects the easing of COVID-19 restrictions in May on auctions, open houses and mobility in general. According to the ABS, new owner-occupier loans rose 5.5%, while investor loan commitments increased 8.1% over the month. Owner-occupier loans through first home buyer loan schemes rose 3.3% over this period. AMP Capital economist Shane Oliver does not expect a change in interest rates anytime soon. Homeowners and property investors should expect low interest rates for at least another 2 years, following the Reserve Bank's decision to leave the cash rate at 0.25%. With the Australian government bond paying only 0.26% on a 2-year term, this provides us with some indication of where the markets think the interest rates are headed, which is nowhere. The market is pricing in no material hikes for the next 2 years. The RBA says that the economic downturn is not as severe as earlier expected, and a recovery is now underway in most of Australia. It is important to remember that Australia's fundamentals in a post-COVID-19 period remain strong in comparison with the rest of the world, and a property investment today should prove successful over the medium to long term. Please subscribe to our YouTube channel so that you don't miss out on our area reports, our webinars, and further news updates. Leave us a comment below and let us know if you have any questions or concerns, anything to do with your property buying. Please check out our website for more details on our services and how our advisors and buyers agents can help you, and I will see you soon. Bye.